Welcome to FundooMoney web series on tax filing. We're discussing various aspects people need to keep in mind while filing for taxes. In this particular segment, we intend to discuss various aspects that you need to keep in mind, especially related to any sale that you might have done of debt mutual funds or gold mutual funds. So debt mutual funds would be mutual funds which invest your money, money of investors, in debt securities, and gold mutual funds likewise would be mutual funds which invest in gold. Now with me is eminent financial expert Swami Saran Sharma, and he's going to help us understand the things that one needs to do while filing for taxes, taking account this particular aspect of income.
Yeah. Then for as far as debt mutual funds are concerned, the period of holding of those debt mutual funds were actually changed a couple of years back. So now you have to hold them for a period of 3 years to be able to be termed it as a long-term capital gain or a capital loss. So when you sell mutual funds in any particular financial year, you either make a gain or you make a loss.
Mm-hmm.
So in case you make a gain, and if you have held this those units for more than 3 years, then you can adjust your purchase cost as per indexation, cost inflation indexation. So the actual amount of gain will be sale price minus the adjusted cost against inflation, and the remaining amount is to be taxed. That is added to your regular income.
Mm-hmm.
In case you sell those units before you complete 3 years of holding, then the entire amount is added to your regular income and taxed as per your tax slab.
Okay, so I'm trying to simplify this further. So what happens is, if you actually sold a debt mutual fund last year and you held those mutual fund units for less than 3 years, all that money, all that good news will get added to your taxable income, and it's going to get taxed at your relevant sort of applicable tax slab, tax rate.
Right.
However, if you had held the debt mutual fund units for more than 3 years, what's going to happen is, whatever was the price of the unit at which you bought, that's going to get adjusted for the inflation index. So if the index, say, was hypothetically 100 at some point, and when you sold it, it was 150, so that adjustment would be made. So if you bought the unit for 10 rupees, it's not going to be counted as 10 rupees. It's going to get the unit price is going to be elevated by the amount of inflation. So actually what's happening is, the capital gain that you're making is becoming less. This is for tax purposes, by the way. So you're ending up paying lesser taxes. So the net message is that when you hold for a longer term, you end up paying less capital gains tax.
And also then the rate of taxation in that case is flat 20%.
Sure.
Because you may otherwise be in a 30% tax slab. But when you hold it for more than 3 years, it becomes a long-term gain, and even on the lower amount of taxes calculated after indexing your purchase price, you pay only 20% tax.
So two benefits. One is, inflation for a change comes and helps you. It enhances the value that tax guys allow you to attribute to the your investment, the original cost of investment. Second is, the rate is lower. Now, Swami, is the gold mutual fund, suppose somebody sort of sold gold mutual funds, would the treatment be the same as debt mutual funds?
Exactly the same.
Wonderful. So these are, I'm sure people would have found this information useful. If people want more information is available. You just have to go to our social media platforms, enjoy the information. If you want more information, write to us, or you can visit our website www.fundoomoney.com.